See if this actually works. And we are live on Oz Property Investor. We bring the big names and we have the big fun. Joe, how you going? Take two.
Mate, round two. Let's do it. Time for property portfolio deep dive. I'm very good, mate. How are you?
That is good. Good to hear. Good
hear.
Answer.
Great answer.
No, I'm good, man. Today it's
no, man. I'm excited for this one.
Here we go. We're live on Facebook. How good is that, mate? I don't know. I managed to get it right most of the time, but yeah. No, it's going to be a fantastic session. So a couple of months ago, we launched the Oz Property Investors Portfolio, 150K passive income. And so that's what this session is largely going to be about. And the key principles that so first off, we're going to go through, well, what's actually happened that time? What have we done? Have we bought a property or have we renovated or have we done nothing? So it's exciting but we're going to be giving the real numbers. We're not not sugarcoating. We haven't made 500K in 2 months. Not like some other some people would sort of say that that's what they're doing. But then we're going to talk to, well, what are some of the key principles that have been used to build this portfolio? And some of those are going to be, well, leverage and buying the CBD versus further out. And you'll have to stay tuned for the rest of those. And then we're going to talk, well, what's going to happen next in 2025 with the portfolio? So I've been probably working too much on this today, but no, it's exciting. So what's exciting you about this session, Joe?
Mate, this session, I had a conversation with an investor about 3-4 weeks ago, and they're like, Joe, I'm literally brand new to all this. I'm like, yeah, so property investing. No. Wheel it all back and just kind of take me back to the beginning of how this whole property investing thing works and how does it make sense? Because I don't know anything about it. I've got a PPOR. I've built that over the last 10, 15, 20 years. I just want to go. So I really want this to be a two-part situation. One, where we do a portfolio deep dive of an updating of where we stand on the portfolio. And then number two, high-level overview snapshot of why we like property investing and how it kind of works from more of a beginner mindset and what that holistic overview looks like. And then also bust some myths, like what Jeff said. You should buy near the CBD because that's where the capital growth is. Maybe not. Let's see what the data says. But that's why I'm excited about this one, mate. I think we should just jump straight in. I think, well, actually, who are we dealing with, mate? Who are we dealing with?
So before we get to that, if you have questions or comments or concerns, send the concerns to Joe, but send the questions and comments towards me, and we'll answer as many of those as we can. So drop those as we're going along. There's going to be some gold nuggets sprinkled in. But for those who've been not involved in Oz Property if you haven't got that badge for joining from day one, I would sort of suggest you make an inquiry to admin, maybe me, but no. So we've got Joe joining us, and you've got over 15 years of sales, research, and negotiation with property and legal tech industry. So I feel 15 years. You feel too young for that, but you are an active property investor and active in many ways. You're still doing it, but you're also you like to sort of get your hands dirty. You like a good reno. You like a good development, all those sort of good stuff, as I do too. And you've got that multi-million-dollar property portfolio in addition to the portfolio we're building together. But also you've got your passion for property investing. You decided to co-found Oz Property with myself, and we are Australia's largest Facebook property group. And this is formed out of the passion for wanting to help share the journey, do all that sort of good stuff. But you are also the founder and CEO. I think you're the CEO, probably the CEO, the Jack of Joe of every trade of Property Principles as well, if you haven't heard that. So who's Jeff?
Property Principles Buyers Agent. Lovely little buyers agency we have. This is Jeff Miles, guys. Because this is the funny thing, because we do all these intros for the guests, and then like people are like, actually, who is Jeff and Joe? And then we'll get 6,000 new members in the group, and we're like, oh shit, actually, these people don't know who these people are. So guys, we've got Jeff Miles, the one and only. He is an absolute property expert. I think I met Jeff probably, I don't know, 10 years ago or something, maybe 8 years ago. He used to be a mortgage broker. He wrote $10 million worth of loans in a quarter. Is that right, Jeff? 10 million in a quarter? That's a pretty interesting number.
That's right.
That's a lot of loans. Used to work in risk and compliance for some of the big four banks, and then also a sound property developer, renovator, and co-owner of Oz Property Investors, Australia's largest property investment group, and also co-owner of Oz Property $150,000 property portfolio. And that's what this session is all about, guys. It's about how we're going to do this and build it along. One thing to mention about this whole property portfolio thing is that it's a side of our own portfolios, right? So we started purchasing for this property portfolio in June this year. Within 30 days, we acquired $2 million worth of assets. So let's just have a quick snapshot. We are here right now. We have our assets, our resources, our liabilities, and we want to end up at $150,000 of passive income. That's where we want to go. And along the journey, we're going to be acquiring properties to allow us to get there. The way that we're going to be doing this strategy is super straightforward. We don't like to overcomplicate. We don't like to overstress things. You can go out there and do this kind of stuff. First steps first. Maybe Jeff, you talk to this. Talk to the strategy around the foundation, the accumulation, consolidation, and cash flow.
Yeah, so for me, the foundation builds the base. If you don't have that foundation, it's absolutely vital to understand where you're going to go, and that's where you sort of are purchasing. You're building the capital base in mind, and we'll talk to cash flow versus capital growth throughout this session as well. So stay tuned for that. But no, for me, it's about understanding, and of course, everybody's circumstances are different. Like some people, if you're an absolute baller, if you've got $1 million and sometimes you do have $1 million saved, and I'm like, what the heck have you been doing with that money? But no, so those people are just your average Jeff or Joe or Jess, to throw another person in the mix. It's about sort of building that portfolio, figuring out, well, how much, what do I sort of need more? And typically it's going to be the capital growth initially, and not to say you're sacrificing that. So it's accumulation sort of starting off, and then we'll throw it over to Joe. What do you do after your accumulation, and what's involved in accumulation as well?
Well, this is typically what's going to happen. We only have a limited amount of capital, cash equity, and then we also have a limited amount of borrowing capacity and serviceability. So it's going to get to a point where we accumulate assets that are ugly ducklings, that have granny flat potential, that have subdivision potential, that essentially have frozen equity that we can some point unlock. We don't need to be doing the subdivisions right now. We don't need to be doing the developments right now. We are doing the renovations right now, but then we will start to destroy the debt and pay down the debt to then eventually end up in the cash flow side of things. Now, towards the tail end of this, we're going to start talking about why focusing entirely just on cash flow is a fool's errand and a loser's game, and why focusing entirely on capital growth is also not really sustainable. So stay tuned for that. I'm just going to quickly breeze through the portfolio just so we're all across it. So this is what it looks like right now. No, not yet. It's not what it looks like right now. So we have 3 purchases. Property number 1, we bought this property in Melbourne in June of this year. The entire purpose of this property is a 3 to 4 bedroom conversion. Why are we doing a 3 to 4 bedroom conversion? Is because look at the disparity in this region of a 3 bedroom and a 4 bedroom home. It is whatever that difference is between 590,000 and 681.
91,000.
99,000?
91.
Yeah. Okay, there you go, $91,000 difference by putting a wall up. And that's exactly what we are doing on this property. So we purchased this property for $606,000. That took $119,000, $265,000 of $190,265. A renovation we planned, and planning is a difficult one because we've overspent. So we're going to share that number as well. So we planned a $20,000 rent, reno, and then the rent is going to be $19,760 as it stands if we rented it in its ugly duckling 3-bedroom, 2-bathroom standing point. I just got the property revalued before we did the 3-bedroom conversion. I've got a statement from CBA who says, from a broker, saying that, Joe, this property that you guys purchased, you purchased it for $606,000, is now worth $641,000 because we bought in the right place at the right time. We negotiated it really well and we acquired the asset really well. So already that is 606,000 minus 641. That is $35,000 of instant equity because we bought well, negotiated strong, and got a great deal. Does that kind of Anything
Yeah,
else
I just
to?
wanted to talk to that,
Yeah.
Joe, because yes, this is Melbourne, and as we know, and I'll talk to us about timing the market, and we'll talk about the strategy here. We've sort of pigeon-paired out this property portfolio. So there's a couple down there, Victoria, one up in sort of Townsville, which if you've been buying in Townsville, you understand what's going on up there. But so in terms of that valuation, yes, it may seem low. First off, valuations in terms of the realestate.com kind of and those estimates, they're not always as accurate as what they could be, but they're also conservative. Now, particularly in a market where there may not necessarily be a whole bunch of confidence, but there is opportunity, I suppose. So I sort of see this purchase we made was purchased extremely well, and that subsequently you kind of are building in there. But what will happen, I believe, over the next 12 to 18 months, you'll start to see that valuation will start to, you'll see the properties that are transacting now. So there'll be a lag of the valuation. Now, working in broking, I used to see this day in, day out. People would buy a property and they'd be like, oh, but I bought it so well. It's like, well, you have to wait that 3 to 6 months at least. And in a market where, because valuers are extremely conservative, and even your desktop. So you need to see those sales, comparable sales flow through. So I would suspect 12 to 18 months, once we start to see the green shoots really sort of take hold in Melbourne and Victoria, but particularly Melbourne, I'm sort of seeing that being a market in 12, 18 months where there's a good amount of potential. Now, you need to be careful. So you can't just buy anything. But, yeah, that's where I see some value coming through with that particular purchase.
Yeah, 100%. And it also comes down to timing the market at the right point. Do you want to be buying in a market and what do you need for your portfolio, right? So we have a portfolio where we want to capture all of the growth cycle. We don't want to be buying in a market that's halfway through a growth cycle that's going to give us a boost of 10% in the next 6 months and then maybe taper off. We want to be riding the full cycle because we can afford to do it. The yields are a little bit lower in Victoria, so you do have to factor that in, but it's not actually ridiculous. Insurance rates like they are in Queensland, regional Queensland, are not as high. Instead of being $3,000 in regional Queensland, in Victoria, it's more like $1,200. And then also council rates as well. I'm just going to share this video because I did boots on the ground in the Victoria market, and I hope you can hear it. So let me know if you can't hear this little video, because this is what we did. This is what the test we're at right now for this one.
Can't hear it. Oh, I think you can hear it, but it's lagging a little bit. Yeah. Maybe give us a running commentary, Joe. What's going on with the property? Give us you remember the words.
A little bit hard to hear. So essentially, see that room there, see that doorway there? We filled that in and we turned it into a 4-bedroom property to do exactly what we were trying to do from before, convert it from a 3-bed to 4-bed. Does it actually mean the value of this property has gone up by $90,000? No, not particularly. Not really. But what it does do is it forces the valuer's hand. Now, look at the bathroom, super gross. The tiles were falling off. We did some tile paint, and look at the difference that this thing makes. So we're around 20, 25. I reckon we'll probably end up with 30. The reason I think we're going to end up with 30 is because Jeff and I have been very lazy, and the renovation has taken a long time, purely because we have not kept on top of what we should have been keeping on top of. So we are overpaying in terms of full disclosure.
Full transparency. I just love that you're actually we're sharing that. Yes, like life gets busy, and this is a reality of being a property investor. So I think that's absolutely vital that we're not just sort of saying, oh yeah, we did the reno in like 2 days, and automatically now it's worth sort of 80K more, like, and it rents for $100 a week more. You sort of see these kind of examples. So it's the reality of property investing. It doesn't always fall in your favor. Just to kind of share that with a lot of transparency.
Yeah, so the rent beforehand was about $380 a week is what we'd get it for in its current state. We'll probably get it for about $450 to $480 $480 a week rent in its new state. So that is property number one. I just kind of want to fly through this reno update because I think it's worthwhile, but I think there's other things to
Can we ask the question,
here.
Joe? Somebody's asked how much for the wall alone. Was that probably 2, 3, 4,000?
Yeah, no, I think it was like $4,000-ish dollars. Yeah. So for the wall alone, $4,000 because they had to patch. So for this one, it was put a wall up, but also patch and fill a door in. So they had to do a bit of both. But also it's the same thing. They've got to put a doorway in if you are doing it. So yeah, our first subdivision, our first door wall combo was like 2.5 all those years ago. Now it's gone up in price with trades. So yeah, good question. Very good question. But it makes such a difference, like by doing something like that. This Townsville deal, this is number 2. This is a very different type of deal. We are deliberately buying this property in a hot market, and here are the numbers, right? This is the Oz property portfolio. This is what the numbers are. So as we haven't finished the renovation, we can't say that this property is worth $680,000. But when it is worth $680,000, we would have created $74,000 worth of value with $20,000 to $30,000 worth of renovation, which then gives us, we put $1 in, we then get $1.50, $2 back, $3 back if we're lucky. With the Townsville subdivision property, the reason why we purchased this one was to do a 1 into 2 subdivision. It's a hot market right now. I would actually probably hazard to say that Townsville is the hottest market in Australia right now. I don't know. Would you agree with that, Jeff? It is. It is so hard to buy in that market right now at reasonable price.
Of course, it's behind Wollongong, but no, I may have a little bit of bias there. No, Wollongong's definitely not the hottest market in Australia. No, I think it's right up there. I think it's kind of overtaken your Perths and your Adelaide, and yes, there's many suburbs within, and there's many suburbs in Townsville as well. So, for me, although the Geelong deal is fantastic, Townsville for me is probably one of my more favorite because it has that. The Geelong one, which we'll talk about, the Townsville one, though, has the opportunity to really significantly reduce the debt of that property. Once you subdivide it, chop that little piece of land off at the back, and then if you wanted to, or you could even do a granny, there's many opportunities to do that. I would say that's probably close to 480 as well. I think 455 is conservative, and I like conservative, so I like that we've put our numbers there lower, but I think that would sell for 480 most days of the week up there.
Yeah, definitely. I agree. 800 and odd square meter block, perfectly subdividable, easy peasy as. This is a future value add. This is not something that we need to touch right now. We've got opportunities. We've got the opportunity for a granny flat. We've got the opportunity for a subdivision. That's going to allow us to build out. Going back to our strategy, we ain't touching this right now. We're building the accumulation and the foundation phase, and then we will come back and destroy the debt by doing these strategies, okay, if that makes sense. So try and build a portfolio with these type of things. However, one thing I do just want to mention on the property portfolio side of things, you don't have to be a renovator. You don't have to be a renovation expert. We are doing the renovation to turn $1 into $2, to turn, $30,000 into $60,000. So we're doing that to get that little extra bump. But as I just showed you, we purchased that property for $606,000, and organically in the market, it's already grown to $641,000, right? So we've already got $35,000 worth of capital growth. You don't need to renovate. You can just buy a set and forget property without doing it. We're trying to build a portfolio where we accelerate it quickly. So we are doing those more value add strategies. So that's just something else to kind of mention. So this is a subdividable deal that's going to be sat and there. Now, I wanted to talk to Geelong real quickly. We have done nothing on it. We haven't touched it at all. We've got all our tenants in. They're sequentially coming through where our rent is increasing. So whatever rent I have on here has gone up by $50 or something like that. So we're at a 6.35% yield when we purchased it. We're probably more at like a 6.8% yield now. Which is awesome. And we've got some strategies for that deal.
I think we'll have to do a breakdown.
One thing I do just want to yeah.
Sorry,
yeah, one thing I just want to post is that we bought 4 2-bedroom units This property here, which is in Geelong, which is kind of close to ours, a slightly larger size block of a 3-unit block, 1, 2, 3, it sold for $980,000. Our property sold for $1,015,000, and it has 4 units. So we pretty much got 1 unit for $55,000, right? So the valuation that we have here of $1,025,000 is well off. Like that's probably more like, I don't know, 1.1, something around that kind of valuation wise, but it doesn't matter. This is not an equity harvest play right now. We're not extracting the equity, but as you can see, the value that we're increasing, like if we did actually get this valued, what would you say, Jeff? It's like $100,000 for a 1-bedroom, $100,000 extra for a 1-bedroom.
It'd be interesting to see what it would value at, because you'd sort of, because it is going to be a commercial sort of a bit tougher to value, but you could argue 1.05 to 1.1 you'd come through if you strata title them. I reckon you could really boost that, but that's for down the track, and we'll do that. So let's crack on. We'll do that in a different. So Joe, you're first up, man. So we could have done.
What am I first up with?
So, first up, sorry, actually I think I might be first up. I am first up. So we are talking the first core principle to build your 150K passive income portfolio is it's leverage. So leverage, and why it's the 8th wonder of the world. So Einstein said that quote. So he said leverage, and the Archimedes lever. So I'm sort of bringing out all the classics now. So what do you think about leverage, people? Drop your comments. Is it too risky? Are you fearful of debt, or do you get excited when you get your next to loan? Sort of spoiler alert, for next week, I might be getting some finance as well. But no, so leverage, the reason why leverage, it's for me arguably the most important part, or the key benefit of the property as an asset class. And it allows you to amplify that borrowed capital. And depending on, so some people say you need that 20% deposit. So for me, 20% deposit, avoid LMI. LMI, I'm more than comfortable to pay that to get into the asset sooner. But to just to clarify, yes, there is risk when you're leveraging, but to put it this way, if you're able to save a 12% deposit on a 500K property, which is roughly plus your costs, let's say it's between 70 and 80K of your own money, you're able to then leverage into that asset, which is worth that 500,000. If that asset then grows by, let's say it grows by 15%, that's 75,000. And I'm not going to promise that'll happen in the first 6 or 12 months. It'll happen when it happens. But what that'll then do is it'll then give you that cash on cash return of 100% plus. Now, I know it sounds it almost sounds too good to be true, but that is, are you bringing up the Money Smart, Joe? Are you looking at this? There you go.
Yeah. So I just want to highlight the point here of what Jeff is talking about. We put down $407,000 to acquire this $2 million property portfolio, right? We put down $407,000. Yes, one thing to mention is, yes, we are further along our property journey. We have equity, we have cash, we have starting this property portfolio with $500,000. So we are in a far better position than a lot of people, and I appreciate that. But we can't just start with 150,000 and that'll be a boring show and we'll acquire property over 10 years, which we will acquire property over 10 years. But what Jeff is saying here is, look at this return, $400,000 of cash down, and we've increased the value by $200,000, right? That's 50% return on capital from an equity standpoint. So where can we invest $400,000 and get 50% in under 6 months? Because we're using leverage. We're using the bank's money to amplify our return. So yeah, this is what Jeff is talking about here. So if you have $100,000, and again, I know that some of the more experienced investors that have been a part of this community for a long time, I just want to have, we've shown this before. So let's choose the alternatives. We have $100,000 and we invest that into gold. We invest that into shares. We invest that into crypto. We invest it into something that isn't leveraged, and it doesn't have that leverage that Jeff is talking about here. So let's do that. This is the Money Spark calculator. All those years ago, I put my portfolio into this and I was like, holy shit, I have to choose property as my investment vehicle because there's no other option that can give me this return. So you take that $100,000 and let's just go with shares. My first share was Woolworths, and let's just do that all over again. And let's say Woolworths returned 7%. So year one, my $100,000 at 7% has grown $7,229,000. Yes, $107,229. So congratulations, we've made $7,000. Good on you. Happy days. Let's roll it out to year 5. It has now grown from $100,000 to $141,000. Year 10 at 7% compound interest, that will double your money. So I have $100,000. I now have $200,000. By year 20, that $100,000 has turned into $400,000. So you 4x your return. Congratulations. So you can see as the equity continues to grow and it compounds over the top of itself, that accelerates the growth. So, wow, happy days.
So I will, and I know you bristle a little bit when I say this, but just for the share investors, and I even see Greg tagging Gurav. We had Gurav on the show a couple of weeks ago, but you technically can leverage shares. You can leverage probably about sort of 50 or 60%. It is a riskier pursuit, in my opinion. Doing that because then you're exposing yourself potentially to margin calls. So you can leverage other asset classes. And I don't know if you've been following it, Joe, but Bitcoin after Trump 2024 got in, mate, Bitcoin went to the bloody moon. It has gone to all-time highs. So Bitcoin is going okay. Really? I'm not saying to go and buy Bitcoin. I mean, but yeah, anyway. So just to kind of level it out a little bit. But no, and the beauty around leverage, if you can't leverage an asset, it just takes longer. You don't have that momentum, you don't have that ability. The other beauty with sorry, go.
Yeah, let's do it. Like, let's see what happens. So we're gonna wheel back the clock. We've got $100,000. We've turned it into $400,000 in 20 years. Good on you. Happy days. But let's change that story around a little bit. So let's take that $100,000 and buy a $500,000 property here, right? We've got the same money, but now we've used the bank's $400,000 to get a loan to make it a $500,000 property. And let's just say we have moderate growth. So instead of 7% growth, we're actually only going to have 5%. Now, capital growth over the last 30 years has been 6.9% in the Australian property market. So, but let's just say we're underperforming. So you're not choosing the best properties that you could. You're not choosing the Oz property portfolio that we've purchased. So year one, we have $500,000. 5% return is $25,000. And you're probably like, what? 25? I thought on shares, we got 7. Yeah, you got 7 because it's not leveraged. Year 5, $500,000 has now made you $141,000. So you've already doubled your money and got $141,000 extras. In 10 years' time, you've grown your $100,000 and you've turned it into $323,000. So let's roll to the year at which it outpaces that share strategy of non-leveraged asset at 7%. A 5% property in year 12 will grow $409,000. So you're at the same point. But if you continue to year 20, that $100,000 has now quadrupled, has times by 8, octupled, or whatever that word is, to $856,000.
I like that word.
And you now how octickled. So this is why I chose property. This is why I choose property over every other asset class. And because I'm using leverage and the bank's money to allow me to get in it. Also, guys, feel free to jump into the comments here because it's when it's a guest, it's kind of hard to answer questions, but when it's just Jeff and Joe, it's a lot easier.
We can just cut over each other. No, we won't do that. So, Joe, I just wanted to say, finishing off on the whole leverage point is you can even, if you are savvy and have a really investment savvy mortgage broker, you can structure your portfolio and look at interest only lending and if you can consider, which yes is taking on more risk. I don't want to Oh, yeah, there you go. Apparently Joe's audio is flawless. Geez, I don't know about that. Anyway, I was having issues while somebody else was. But no. Okay, so no, I just wanted to say, in terms of that, you can consider interest-only lending. And if you know there's only a couple, sort of 4 or 5 lenders that will take that. So you can continue to keep leveraging. But this is only more for the really kind of confident and really savvy investors. I just want to, because I don't want you to go there tomorrow and leverage yourself to the hilt. You need to be mindful of that sort of thing. The other thing I was going to say is consider your exit strategy. So we've got this Oz property portfolio where we're sort of tracking about 10 years. So somebody asked about what the time frame was. For me, to get to that 150K for our situation, it's going to be roughly about 10 years. Now we could do it, give or take a couple of years either way. Might be able to do it a little bit quicker. For most people, yeah, it might be 15, 20 years. You might be able to do it in 10 years. So it depends on how quickly you want to go, how hard you want to hustle, all that sort of good stuff. The other thing, the other thing that almost became a principle in this 150K is rent vesting, because it's really the topic. And if you do a search on Jeff Miles rent vesting, go and do it. Let me know your thoughts. Jeff Miles rent vesting. I was one of the, I wouldn't say OGs because it was probably around for me, but 2017, there was an article on me and it got me into, actually, no, it was earlier than, I don't know when it was. It was probably 2015, 2016. But there was an article there that spoke about the benefits of rent vesting. So, and we haven't, so we're not going to unpack that. We'll do a quick kind of session on that. But so, Joe, I'm going to handball it over to you. This is really a key kind of principle. We've got some big ones coming up. We've got time in the market versus time in the market. But next up, we're going to talk to, should you focus on capital growth or cash flow? What are your thoughts, audience? What should we be focusing on? And what are your thoughts, Joe?
It's a bloody good question. Should you? Well, should you? Like, what should you be doing? Should you? Because this is the hard thing, right? The biggest, like I said it at the outset, right? If you're focusing just on cash flow, you're playing a loser's game, because you won't be able to grab the equity out and then go again. So I've, I think, got a little slide here that's going to kind of talk to things a little bit more. I'm going to try and zoom it in so that it makes a little bit more sense for everyone. So if you just bear with me. So we have two properties here. And what we're going to do is called property A and property B. So we are going to go out there and buy this property here at $600,000. So it's $600,000, and it is going to give us a yield of $520 a week, right? Property A is going to give us $600,000. It's going to be $520 a week, which is a 4.51% yielding property. Property B is going to go off to a mining town. Now, mining towns have a lot of fly-in, fly-out work, and those towns don't really have a lot of accommodation. So what happens is a big mine opens up and they need 500, 800, 1,000 staff members that are all moneyed to the gills. These people you're going to an area that has, medium income of $60,000. And all of a sudden, these big mining people come in here with $200,000, $300,000 incomes. They can afford to push the rents up, and there is no more supply of stock on the market. And then rents boom, right? For a period of time while that mine is open. And this is why you need to have the economics of the area need to change. So anyway, changing all of that. One property, $520 a week. Second property, $800 a week, right? One is 4.5%. And the other is 6.93%. On paper, that's $27,000 a year in rent for our property A. Property B is going to give us $41,000 of rent. Expenses is $11,162 for property B. Property C is $12,000. So everything's equal except for everything's equal, but property management is a little bit higher because the rent is a lot higher. So if we look at these two properties and just focus on a cash flow perspective, property A is losing $13,000 a year. Property B is giving us $472 a year. So focusing, if we look at all things being equal, and these are the only numbers that you're looking at, property B in the mining town is the better option. However, when you start to increase more variables, that's a $13,300 difference. But let's now look at the growth rate. How much capital growth will that property and that market have? Property A now is going to grow at 7%. Property B is going to grow at 3%. That on property A is $42,000 of capital growth. Property B, it's $18,000 of capital growth. So what that means overall from a net perspective is property A now has 54,000. Actually, that's wrong. It's 42 minus. Yeah, it's $29,000 worth of growth. And then this one has
it's a little bit closer. Team cash flow is not going too bad, but you're also there. I mean, this is a simple example because you haven't factored in negative gearing, have you, Joe? And negative gearing is a dirty word, but you haven't factored in negative gearing, have you, in this one?
No, we have not focused in negative gearing, but we also haven't focused on the tax that you pay on the income that you're getting from property number one. So capital gains, the beauty. Okay, so why are you telling me all of this, Joe? So this is why, because capital growth is the most important thing when you're starting out a portfolio. You need to be able to grow that property's value so that you can continue growing again. So right now, this property has $29,000, $30,000, $40,000 worth of capital growth. You can then take that equity out eventually, let's say 2 years, 3 years, 4 years time. You can take that equity out and then go again. For property number two, at the $18,000, it's going to take a lot longer. It's going to take 6, 8, 10 years before you get that capital growth to be able to go again. Also, capital gains is not taxed. So there is a thing called, capital, not tax, financial advice and all of that stuff. Capital gains when you sell a property is taxed, but when you pull out equity, that isn't taxed. So you can take the full equity whack out. So rather than needing to sell the asset and go again, you can take out your capital. So you're not taxed on the gains, if that makes sense. So you've got to use the equity to be able to then go again on the next one. This is how people win. Be a winner, not a loser.
I just wanted to call this out, Joe. You mentioned mining town, and my ears pricked up. And if you said you shouldn't have used the word mining town, because as soon as you said that, like, you're not getting, what was it, $800 for rent a week. You need to jack that up to at least 1,000, maybe 1,200. I might be, just as a thought experiment, looking at some of these mining towns just to see how that cycle plays out. Because funny story, back in 2010. When I was a youngster, when I didn't have any facial hair, I still don't have any. But no, back in 2010, my first property purchase was almost in a mining town. So that is a controversial moment, because I was sort of like, everything was going absolutely gangbusters in places like Port Hedland, Carafa. But I'm just glad that I did not execute, or that I just wasn't in a position mentally, or I suppose educated enough to be able to do that, because that would have been financially ruinous for me. But no, I agree with that. The rent would be a little bit more in a mining town. So but anyway, I think you illustrated your point quite well. Because,
yeah. The other point that I want to make is, right, you need cash flow to be able to borrow more. So everything in life is a balance. You need both cash flow and capital growth in the portfolio. So if we look at this situation,
that's what we've done. We have kind of balanced that to some degree, because your Melbourne property is not great cash flow. The Townsville property is not too bad. It's average. Your unit block in Geelong is pretty good from cash flow perspective. Yes, there's some land tax, but no. Have you got the numbers there, Joe? Have you got the spreadsheet?
Yeah. So going back to what I was talking about here of why you need to balance the portfolio is, if you have a $2 million property portfolio that's bringing in $75,000 worth of rent, that's a 3.7% yield. That's maxed you out. You can't borrow any more money. If you've got a $2 million property portfolio with $150,000 in rent, hypothetically, this is all just a hypothetical, that's a 7.5% yield. That allows you to borrow more money. So the cash keeps you in the game. The borrowing and the equity allows you to keep pushing forward, but the cash is the thing that gets you there. So the capital growth leads to the equity. The more equity that you get, the faster that you're able to save. You're not actually saving $1. You're saving equity by growing the property portfolio. That leads to more growth, which allows you to get to more equity. And that is why you don't focus on capital growth. That's why you don't focus on cash flow, and why you need to consider capital growth as the key thing. However, if you can borrow $2 million and go out there and buy a Bondi apartment for $2 million and get a 3.5% yield, that is heavily cash flowed, and that's going to eat into your borrowing ability and your serviceability, and you won't be able to borrow anymore. If you go out there and try and find a 4.5%, 5.5%, 6.5% yield in good growth markets, 6.5 is a bit too aggressive. To be honest, I would be focusing more on the 4.5 to the 5.5. You will be able to continue extending and building a portfolio potentially. Not financial advice and all that.
No. So what I want to say, and on that kind of cash flow, and I've heard this number, and I believe it to, from my experience, to be largely correct. A 1% yield, only because that's the thing that a lot of people who focus on cash flow, and I'm kind of a believer of balance. I love balance, but that will add somewhere between 20 to 30K, a 1% yield. So let's just say you're buying a property at 4%, and which is probably more capital growth focused versus a more cash flow focused. And cash flow focus can grow, of course. It's not to say that, but a 6%, let's just say that. So there's a 2 percentage point yielding difference. And that will probably equate to about a 40 to 60K borrowing capacity difference, which is not nothing. But to me, that differential doesn't justify going for a more heavily cash flow focused property in the kind of to sort of just to purely do that cash flow play, sacrifice capital growth. So let's get to our next point, Joe. And what questions do people have on that anyway, before we go to cash flow versus capital, so finishing off on cash flow versus capital growth. Next thing is going to be time in the market versus time in the market, which is a very hot button topic, I felt, when I did that post.
Well, let's talk to it, mate. I think what is? Can you just explain what timing the market means and what timing the market means, so it kind of makes, just to dumb it down a little bit.
Say 10 times fast 10 times fast at home teams. Timing. Yeah, I can't even do it myself. So time in the market is essentially where you are buying, and you're not kind of factoring in largely. You're not looking so much about what the market is necessarily doing. You're literally just saying, okay, I'm going to buy this property, and the old adage of property will double every 7 to 10 years, which is, I feel, been proven to be not necessarily the case many times over. So I'm not going to go and prove that again, but maybe we will. So there are some locations. So yeah, that's kind of time in the market, where you're relying on simply sort of buying a property in a location. Time in the market is actually being a little bit more, I would argue, sophisticated, and saying, okay, well, what is that market? What do I need what is the strategy I need? Do I need something that's going to grow in the next, is it what they call, I suppose, a hotspot? Something that's going to grow in 1 to 3 years. It's going to see that sort of 20 to 30 to 50, 60% growth. But then maybe after that, maybe it's not going to go. So that's kind of where I see is time in the market. And then you just got to be comfortable that after that sort of 3-year period, you may not necessarily see a lot of growth, because it depends on when you're entering. And then there's kind of that sort of middle sort of spot where you sort of say that there is potentially some green shoots, but you may not see that growth for 1 to 2 years. And and then it comes back to, what is your strategy? What do you need in your portfolio at the moment? If you're capital growth intensive to need to keep growing, then maybe you are sort of more focused on time in the market, I would say. Does that make sense, Joe? Does that make sense to everybody?
That kind of makes sense. That kind of makes sense. Timing.
Yeah.
Just try and do both is my answer, but let's talk.
I agree. Yeah. Because I mean, to me, why would I just purely rely on just buying a property in any old market? I want to sort of make sure that I'm optimizing my returns. So it comes back to that opportunity cost. Because let's throw to example now. Let's go to that Kerwin one that I brought up there. And I'll try to describe this for those listening to the podcast. But bring it up, Joe, and we'll just show
what can. Up.
Yeah. But no, for anybody sort of watching at home, what are your thoughts? Are you team time in, or are you team time in the market? Gee, I don't want to say that too much, because it's just.
So what's the?
It's the first one, Joe.
So we'll stop trying to say it. Stop trying to say it.
22 Malaga.
Okay. So what do we look? 22 Malaga Street, Kerwin in Queensland. So this is a Townsville property. This is a property that's kind of close to where we bought our Townsville property.
It is, yeah.
Exciting.
So zoom in a little bit. So if we go back in time to 1993, so if we look, this person who bought in November 1993 bought it for 193,000, and now yes, we'll throw a disclosure and just 135,000. I was looking at the 2019 one. And then in 2007, so Townsville absolutely went through epic precautions boom from about sort of 2002. I would imagine if they sold that in 2002, it would have sold for about probably 190,000. But between that sort of 2003 to 2007, it absolutely went gangbusters. So it was then sold for 330 in 2007, sort of, let's say 13 years later. Then it's transacted again 2 years later for 335,000 in 2009. So now what happened? And yes, there may have been a favorable purchase. There may have been a distress in that. So there's always those kind of unknowns that you don't know about the situation. But I think that having looked quite closely at the Townsville cycles and the way it worked out. So around 2009, end of the GFC, it's not in the GFC, the sort of fallout of the GFC, it really started to just sort of, the bottom started to fall out of that Townsville market. So that person who purchased it in 2009, 10 years later, almost 10 years later, sold it for 192,000. So that is a loss of over $130,000 in 10 years time. So
okay.
And
so
that's just
2009, you purchased an asset at the peak of the market, right? GFC, things are getting a bit hairy. This person's like, you know what? I'm going to buy this. I'm going to buy this thing because well, it's not even an emotional thing, right? So it's not an investor thing. It's just, I want to live here. This is the price. GFC happens. And then 10 years later, sells it for 192,000. That is a sad, sad story to see because you've held it for 10 years.
Yeah, exactly. And the interesting thing as well is, so this person who picked it up, and they must have just been almost filled. If they looked at what, I mean, it could have been an occupier, but the person, so just over 4 years later, in November of last year, of 2023, they sold it for 400,000. So essentially more than doubled their money in just over 4 years. So to me, that's over 100% growth in 4 years. And a lot of that growth would have probably happened from the end of 2021 to the time. So they would have seen close to 50% growth almost year on year from 2021. And now that asset, if you go up, I think that's estimated at about 520 roughly. If you go up to the core logic.
Yeah, it'll be about 520. I haven't logged in.
No,
so yeah, 100. Yeah, it'll be about. The thing is, that'll be worth 520 now. So even that person that sold out in 2023 is still down $100,000.
I'm actually okay with
timing. It's all about supply and demand.
Though, Joe, because they're moved there. I mean, I suppose it depends on. Yeah, they might have missed a little bit, but I suppose there's a concern. Let's skip through the Logan one. I don't. Yeah, because otherwise we'll be here all night. Let's go to. Yeah, let's go to, because this is the hot topic is Victoria. Melbourne, Bacchus Marsh. And people would argue that Bacchus Marsh is not Melbourne because it's the other side, Western Melbourne. So, but I would say it's metropolitan. It's kind of in the Melbourne, kind of greater Melbourne. So point to that. So go back to the numbers, Joe, for those looking at
greater Melbourne. It's the middle of nowhere.
Yeah. No, it's not.
Middle of nowhere, Melbourne.
Yeah, it's greater Melbourne.
What are you talking about? Anyway, that's not the point. It's about how do you time the market and how are you timing the market? So let's talk to this.
So if we look at this example, and if I'll describe it. So 1987, I'm just going to from 1987 to 2005, it close to tripled. It went from 63,000 to 155,000. So that's what, just under 20 years, so 18 years. So that sort of, and then from 2005 to 2017. So 12 years, so kind of almost two cycles, that it more than sort of doubled. It close to tripled, actually. It more than doubled. It kind of 1.5 times. So you made the interesting thing from 2017, so 8 years it was sold recently as last weekend. Yeah. So in 7 years, it's done 45,000. So let that sink in. That is less than 10,000 per year. Which I mean to me would be
terrible.
Yeah. And you sort of say,
and
well,
this is
yes,
the thing. Like in 2017, if you bought that in Perth, if you invested $400,000 in Perth, it would have done a very similar thing for 3 years. But then that property of $400,000 now invested would probably worth about $800,000.
we've got an
And then
example
you've
from
done
Perth
that
as
in
well.
Victoria because you timed. Oh, do we? Oh, but you've timed the market incorrectly, and you've bought in a market that was on the down, and you've sat there for 8 years and not got any growth at all. That's a sad story. Okay, cool. Do you want to go to the Perth one then?
I just want to highlight, I suppose for me, going back to that Victoria example, you sort of look at that and you say, well, yes, they've done that and all that sort of thing. I want to say that the challenge of selling or trying to time, it's not to say, because somebody came up with this suggestion. They said, well, is your thing to not buy a property at a certain time and then not sell? It's like, well, it depends on what your purpose of buying is. It's to sort of look at the data, look at the metrics, and then sort of understand where a market likely sits. But yeah, go on to, we'll skip through Paralawi. We'll go over to Warnbro, which a lot of people would have been buying here in 2020, 2021. So this is a property in Warnbro. Which
we were saying it 3 years ago. We did a live session, and we did a live session on Rockingham LGA, which is where Warnbro is. So in our business, in my business, we were buying in Warnbro very heavily in 2022. Yeah, sorry, go Jeff.
No, that's all right. So this one was first transacted in. Sorry, again. This one was first transacted in 2004 for 275,000, and then 8 years later, it sold for 400. This was getting close to the Perth boom. The Perth boom ending. So sort of starting plateau. So it sold for 425,000 in May of 2012, and that's kind of not horrible, but it's kind of just tracking along at 50%. So kind of you're roughly, I don't know, you're sort of 6% per year, 6 or 7%. And then 10 years later, you take a time machine, you go 10 years forward. In February of 2022, this property then sold for $431,888. The person buying it must have just thrown an extra $880 just to say, look, I'm sorry for doing this to you. Because they've literally made and probably lost money. We're talking $6,888 in 10 years. And that would have gone down. I would suspect that would have been probably mid twos at its lowest. And then this person has that's 431,880 in April. So it's transacted again recently. So just over 2.5 years later, 735,000. That's over $300,000 in 2 years, just over 2 years.
431,880, and the new value is 735,000. Imagine being that investor that in was it 12, 24 months? Is it 20?
30 months basically.
30 months, right? 30 months is 70% growth. Yeah, 70% growth in that market, which is potential equity gain of $303,000, which is incredible. That's monthly. Every single month it's growing at 2.35% growth. Wow.
I mean, and it's not to say that the challenge is if you do sell, yes, or if you sort of, the problem with trading property is you're interrupting that compounding period. So I would say, why not do both? Why not do your best? You're never going to pick the bottom of any property market, and you're probably not going to pick the top either. So I would sort of say it's absolutely vital to really, if capital growth is a focus, I would say it's important you sort of take a more sophisticated look at your property investing and just say, all you need to do is look at some core metrics, which we're going to talk to sort of a bit later. But yeah, that's kind of, just let that kind of sit home. And it's not to say that you should go and try and time every purchase, but timing is important. Time in is important as well. But what are you up to next, show?
I just think it's that really hammers home the point of timing. It's choosing the right market at the right time. No, cool. Happy days. What's the next myth we're going to bust?
We kind of skipped over. So it is, should you purchase in a CBD or should you purchase a little bit further out?
Ooh.
So what are your thoughts on that team? Are you team CBD or are you team kind of further out? What should we be considering?
Let's find out. This is one of the biggest things that we hear all the time. It is like, no, I want to buy close to the CBD. I've done the data research over different periods of 10 years, 20 years, 30 years. There's no correlation. Property grows at a similar value. It kind of fluctuates a little bit over the long period at the same rate of return, right? So property grows at about the same. It's kind of around that in between 6 and 7% for property investing, right? So what happens is there are periods of absolute growth and boom, right? So we talk about Townsville, and actually this Perth option that Jeff just had. Perth had a massive boom, and then there will be a period of stagnation where it will flatten out. And then over that 10-year period, it's like, oh my gosh, you just had 70% growth. Yes, there'll be periods of where it drops off and drops off, and it will over the 10-year, 20-year period be at that 7%. So sorry, I don't know what that has to do with buying in the CBD. So anyway, looking at the data over the long term, there is no correlation between where the property is purchased over the long term. So one thing that I've done over this little time is pull through all the data, and it took a little bit of time, but I want to show you guys what happens when you buy a property close to the CBD, because it's like 0 to 10 kilometers. I want to buy as close to the CBD as possible because that's what's going to grow as the most. Now, the other thing I hear people say all the time is like, well, yeah, Joe, that's all well and good, but how come, this property in the CBD is more expensive? And is it $1 million? And this property, 40 kilometers away, is it $500,000? And this one's at $2 million. Because it started that way, because that property market was more expensive because it was in the economic center where all the value was getting created. Land soaks up the economic value that a community creates. That's what property investing is. So that's one thing to just point on. But let's just have a look at this chart, because it's probably going to take a little bit explaining. I sent this to Jeff and he was like, you can't share that chart. It's very confusing. And I'm like, no, I can explain it. So please give me a shot. So along this bottom line, just exclude all of this bottom lines, these 4 lines at the bottom, because you can see over a period of time, we have growth over a month, growth over a quarter, growth over 6 months, growth over a year, growth over 3 years, growth over 5 years, and growth over 10 years. So this is data for WA. So how much growth over 10 years based on the x-axis is how many kilometers away from the CBD. So this property here, this location here, between 0 to 10 kilometers, and then 10 to 20 kilometers, 20 to 30 kilometers, 30 to 40 kilometers, 40 to 50 kilometers, 50 to 60, etc., etc. So it then expands out. So should I invest my capital in the CBD because that's going to give me the most amount of growth? If we zoom up over the short term of 3 years, no, you should not. Over the past 3 years, 5 years, and 10 years, the short-term growth has actually, the CBD locations between 0 and 10 kilometers have been outperformed by most other markets, except for anything beyond 90 to 100 kilometers. The markets that have done the best from a capital growth standpoint are 20 to 30, 30 to 40, and 40 to 50. So should you buy closer to the CBD? No, you should not, because it doesn't make any sense. The capital growth is not in the CBD, because a $500,000 property it's not going to grow as much. So let's just hang on. I've got an example here where I talk to the numbers. So I'm just going to say, I'm going to just talk about 1 year, 3 year, and 5 years. If you bought a $500,000 property and you bought it in the CBD, the lowest point, that would be at $590,000 over a year. If you bought it in the market that was moving the most, it would be worth $643,000. Over 10 years, that's $168,000 of difference if you bought in the CBD or if you bought in the better performing markets. Not only that, is the capital, the cash flow in your CBD location will be a lot worse. You won't be getting such a great return because you'll be having such a higher cash outflow because the yields in the cities are less. I've gone through a lot of data there. So does that kind of make sense, Jeff, or have I just kind of butchered it?
No, it makes sense. I mean, the conversation that we had, the conversation that we had before was around, well, is the reason that sort of closer because this is kind of dwellings and I would suppose to me is maybe it is, but I would also sort of then say my thoughts around this when we brought this up as a topic is if you're buying a house, which typically I'm not saying units, you should never buy units, but to me, if you're buying a house within 10 to 15 to 20 Ks of most CBDs these days, not all, like maybe an exception would be Hobart and maybe Perth, maybe still a little bit. But you're going to be fronting up about sort of 700 to 800 to buy a house within 10 to 20 Ks of Sydney. You're looking at least 1 million, 1.5 up to 2 million, depending on what it is, and maybe many more millions. And even Brisbane these days, Brisbane has become very expensive.
So this data is all houses. So it's housing data. So it's should you buy a house between 0 to 10? So this one here is South Australia. So over the last 10 years, if you bought, this has the highest amount of growth and like these little charts are the amount of growth in the median is that the black line in the middle, 20 to 30, 30 to 40, 50 to 60, and 40 to 50 have been the highest growth rates. 40 to 50 and 50 to 60 have been the biggest. So if you invested in a property 50 to 60 way, you would have actually done better. You would have outperformed by a large margin. And it's the exact same story in Brisbane. Like the data for Brisbane is exactly the same. 20 to 30, 30 to 40, 50 to 60 have grown the most out of all of them. I just think that's totally busts the myth of should I buy in a CBD location?
And
no.
I'll just caveat this to say it's probably percentage based, I think. Is it percentage or is it dollar? Like what? Sorry, I like to.
It's percentage based. Yeah. So capital growth over the percentage. Like,
yeah.
So $1 million. So that's, but also who cares if it's percentage or not? Because you've got $1 million that you can go buy in Bondi. Why don't you buy 2 500s in a different area? Like it's the allocation of capital that people should be worrying about, not anything else. Why would you spend $1 million that's growing at why would you spend $1 million that's growing at 4% when you can go spend 2 properties at 500,000 that are growing at 8%? It's the same amount of capital.
I suppose
one
that's
has
the
a better
argument.
yield. One has a better yield, and one has a better, and that one that has the better yield, so you get more cash flow, which allows you more borrowing, is also growing at a faster percentage to give you more capital. So why are you buying in the CBD?
Didn't we just say though that we're team capital growth? Sorry, I couldn't
That's
help
what I'm saying.
I wanted to.
I'm not, but that's what I'm saying. The capital growth isn't there. From a percentage return, $1 million, this is $1 million invested, 0 to 10. It hasn't got the same return. This is $1 million in 10 to 20. If you had $1 million, you're better served buying it between 40 and 50 and 50 and 60 kilometers of Brisbane, because that has had the largest amount of growth. You can see that number there is above that number by almost 2/3. So if you bought in Brisbane CBD or you bought on the outskirts between 50 and 60 kilometers away, you would have done better if you had that $1 million and invested in that market.
Yeah. I mean, my key reason why, I mean, if I had, I mean, I would, the count, and I'm sorry to be difficult, Joe. I'm sorry. You know who I am now. I'm not just somebody who agrees to say agreeing. I do largely agree. The only sort of, if somebody purely just wanted lower kind of maintenance and didn't want to have the hassle of 2 or 3 properties with property managers, and we're talking about this the other day, well, just imagine those people with 50 or 60 property portfolios, they must employ somebody to manage that portfolio for them. And I said, yeah, once we kind of get to 10, 15, whatever number it is, I'm like, yeah, of course I'm going to get to somebody to probably manage that portfolio. But no, I think that's a fair point. So I think that rounds out our core kind of principles. And somebody commented and said, well, this is common sense. Well, yeah, common sense, unfortunately, isn't that common these days, people. So I think it's vital.
No, I mean, I don't think that's fair. That's not fair.
Mm-hmm.
Like, don't judge someone because when they're starting out, you had no idea about property investing. You had no idea about leverage. You had no idea about this stuff. I don't think it's fair to say, oh, this is common sense. Yeah, it might be. It might feel like we're competing on, like, talking about stuff again, but no, it's not. Someone that's just heard this blew my mind. All this content that we're talking about here blew my mind when I heard it. And wait, I can invest $100,000 into an asset that's going to grow at 8%. Yeah. What?
The thing that I thought that I was, because I wasn't 100% sure on the time in versus timing the market, but looking, and yes, you could argue that they're favorable purchases. There's all those kind of caveats you could throw around it. But to me, that I could find that many examples in like, I wasn't looking for hours. I looked in 5 or 10 minutes. I literally looked at the auction results and I didn't find them, the first two that I found. But to me, that kind of then shows, and to the cash flow versus capital growth, everybody says cash flow. But the challenge is, if you can't continue to borrow, if it doesn't grow, then you're stuck. So, but I was born wide for property. So I want to reveal, and we'll get to some of these questions. I want to reveal what 25, and we did promise that. And I've actually come up with some key considerations.
We do that.
Well. Throw to us.
What happens with the portfolio?
Yeah.
The amazing thing with commercial property investing is that in most cases it's cash flow positive from day one, which means that you can drive those profits towards paying down the debt. There are instances with commercial property investing where you can actually have the property pay itself off over 10 years, which is absolutely crazy. With commercial property, you get massive net yields, so you can expect anywhere between 6 to 10%. And as we've seen in the current boom, these properties not only provide large cash flow, they do certainly grow wildly in value too. Now, with big rewards comes some risk, and this is why you should de-risk your investment as much as possible. And the way you do that is with expert due diligence. And this is why we highly recommend people hire professionals to help you along in your investing journey. Steve Polisi of Polisi Property is one such expert. Being a chartered mechanical and structural engineer in a past life, Steve draws on his analytical and mathematical skills to do that expert due diligence for you. With 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He's the guy you want in your corner, crunching the numbers and finding the best properties in the best locations, along with ensuring that you avoid the mistakes. Steve has actually even written the book on commercial property investing in Australia, and not only is it a bestseller, I believe it to be the most comprehensive in commercial property investing on the market today. He's been generous enough to give us a massive discount for our audience of 50%. So use the code OZPROP, click the link below, get a copy today, and start learning and getting on your commercial property investing journey.
We are back. Commercial property. That's one of the. We'll have to get one of our commercial gurus to come on and chat to it. But no, Joe. So I've asked people to throw their questions, and I think we've actually, somebody said exactly, not a matter of common sense or what is that you guys. I'm just trying to read. Offer help with. I offer help with. People often kind of say, what do I do? And it's like, I purely help people in the group. Oh, mate, just sounds arrogant by questioning what it is that I don't want to go down that path. I think it's a valid point. I mean, I don't mind people kind of asking the tough questions. We don't shy away. But so, Joe, what are we, 2025? Where do you kind of, I've crafted a plan in my head, but what do you think we are going to be doing with this portfolio?
Yeah, well, this is the thing. What are the next steps with the property portfolio? I think that as we grow this portfolio, it's going to scale out in stages. Like, this is one thing I think that people need to also think about is it's not all wham bam, every single week you're thinking about property. It sucks. Like, getting a loan sucks. Going to the banks, preparing all the paperwork and blah, blah, blah. It's so annoying. I get so many people where I chatted to about 6 months ago and they're like, yeah, I'm ready to buy a property. I'm like, great, go chat to your broker. And they come back 6 months later, man, that I'm sorry it took so long. It's been tough. But yeah, you got to strategic. Like it's not forever. You then make the purchase, do the things, forget about it, then go through another season, get some capital growth, get some equity, and then go again. So yeah, I guess that's how this property portfolio is going to go. But how are you thinking about it? What kind of strategic acquisitions are you thinking about, mate?
So I love that you mentioned that, because somebody actually posted that up today. It's like they started their property investing in 2020, and they sort of said between 2020 and 2022, it was all gravy. And then it suddenly started to get harder as interest rates rose, and you sort of maybe they got a few tenants sort of request maintenance and things like that. And I just said, well, that's actually property investing. Like he said, give me some motivating words. And I said, well, if you're actually having those kind of challenges and thoughts and ideas, you're probably doing it right. Because if it's just too easy, I think you're probably either under expanding, you're not expanding yourself out enough, or you're sort of ignoring the vital kind of things. So I think that the way I kind of think, I actually loved getting this is really geeky. I mean, maybe people said I'm wired for property, and I'm just wired to do things that kind of optimize, hopefully, lives. But I don't mind that. I really enjoy putting it all together, putting my numbers in a spreadsheet. Like I do like jump up in the air and click my heels. I'm like, it's exciting. I don't know, like it's a bit weird, but yeah, I don't know. It's just that way. So to me, the way I see 2025 out, and you and I need to talk about this behind the scenes. So this is kind of sharing it live. But I said, I'd like to purchase at least one property for the portfolio. Now that's going to, I'd like to do two, but two's going to be absolutely stretching. So we're going to start to talk about the markets that I sort of see where we could potentially be purchasing. But I sort of see value around that sort of 500 to 700K, because you start buying under that. And I'm interested to get your thoughts on the show. I'll stop and ask you what your thoughts are. Anything under that sort of 500, yes, you can still 100% buy it. You can still buy under 450. I'm not saying you can't. You can probably buy a cracking property underneath that. But to me, that's kind of where the sweet spot is starting to lie post-COVID. It's hard to buy under that sort of 450. So 500 to 700 is where I sort of see our next purchase likely sitting. But yeah, we'll have to talk to that. What are your thoughts on that purchase price?
Yeah, actually, I was going to mention this, but I totally spaced on it. At the beginning of the show, is that there's periods of time for different price ranges. So there are periods where, like over the past 2 years, I would say the super duper affordable end was the place to be playing in. Right, the affordable stuff where property prices, land prices started to increase. Creating a new asset, creating a house became very expensive. So people were like, well, I can create a house for $400,000 and put it on a piece of land that I can buy for $250,000, or I can buy this existing dwelling for $500,000. And that's why the prices have continued to skyrocket in the affordable markets. I'm starting to see a shift of where the capital growth value is, and I'm starting to see that shift in the 550 plus to about 750 plus. The everyday Aussie market is where I'm seeing the most amount of capital growth standing at. That sucks, because it means that the yields are going to drop and it's going to compress. It's going to push a couple of people out of the market, but that's just where it's looking to be going. So that's kind of where I see the value. So you will notice in our portfolio, we bought $1 million property, 1.15 or whatever it was, a $606,000 property, and then a $435,000 property. I think we've bought one of the last properties in good markets that is under $500,000. Give it 6 months, and I don't think it's going to be really, really possible to get an asset like that anywhere. But beyond that, I think that, my price range is probably maybe even 650 to 750 is where you're going to get the most. I don't know. What do you think?
Hard. You're right. Can negotiate, but no. And the type of property that I foresee us buying is somewhat. It's probably not going to be a block of units. Definitely not that price, and it's not going to be likely commercial yet. But I see it maybe being something that doesn't need a whole bunch of work. But I'm definitely open to a renovation, ugly duckling, and maybe a granny flat potential. I don't know. Maybe it depends on which, and we'll talk about which markets I sort of see that purchase could be in. I don't know the granny flat specifications of one of these markets that we're potentially looking at. I think it's a dark horse, the one I may be sort of mentioning coming up. But no, to me, the granny flat then gives the opportunity to add that sort of cash flow down the track. And yes, you need to fund the purchase of the granny flat, but it's kind of figuring out, well, yes, the portfolio at the moment is heavily cash flow negative, which is we're happy to sustain, and maybe you can't. But as I said, that's probably likely going to be, or even subdivision potential, going to be struggling at that price point, maybe. But yeah, that's kind of where the purchase, and we'll talk about locations next. What do you want the next type of property to be, Joe?
So what are we talking about?
What type of
What are we
property? Are we buying an ugly duckling? Are we buying a set and forget? Or are we buying when we're talking about terms, are we buying a value add kind of? You're bringing these up now.
Didn't know we were talking about. Yeah, well, this is the thing. Like, what is it? I mean, let's go back to our strategy, right? Now, this is the way that we think about strategy. Is every time you've got that new acquisition, you have to re-go and re-look at your strategy. So currently, we've got 3 acquisitions totaling $2 million. Are we still in the accumulation phase? So do we want to keep forcing the equity, or are we at a point where we can start consolidating, selling down that debt? Now, actually, yeah, let's just go through the numbers, because we actually haven't done this just yet. If we look at the Oz property portfolio, this is what it is. Purchase prices, $2,056,000. Value, $2,260,000. God, I'm terrible at this.
Maybe I should drive.
Value increase is $204,000, which means we have $489,000 worth of equity, which is a 78% LVR. It cost us $407,000 to put all of this stuff together. And our interest rate on average is 7.1%, because we're buying in trusts and structures and all that good stuff. And we're going to bring on our accountant and talk to trusts and structuring and how we've thought about this. The rent that we're getting in yearly is $113,000. So we want to get $150,000 in passive income. In 10 years, it may be close to that, but that's still not covering the expenses, because there's weekly costs. So net annual cash flow, this portfolio is only giving us $70,000 after all debt is paid off. So we only have $70,000. So we're not there yet. So we still have to acquire more. Not even halfway. Yeah, we're at 70. We need to get to 150,000. We're not even halfway there. So in terms of where Joe and Jeff are on this journey, we're going to be along here. Like we're probably about here, a couple of purchases in. We've still got a ways to go. So, yeah, that's my view on this.
And location
purchase 5.1%.
Oh yeah, numbers.
Go on, mate. Sorry.
I was going to say, because we're just... Yeah, and I like it, and I think we'll have to do that at some stage. So stay tuned. But no, locations where I see that is going to be, you're getting your biggest bang for your buck. So as much as I do love Adelaide and I love Perth, I think there's still some potential growth there. For me, given that we probably want to see, some more capital growth, hopefully. I think we're going to be diving deep into places more around Melbourne. And you say, well, why more Melbourne? Possibly Geelong. But you say, well, you've already got a couple down there. Land tax is going to be an issue. There's all these kind of considerations. And I'll throw that into the cash flow calculator and say, does it make sense? If it doesn't make sense, then we may not consider it. The other places may be far north Queensland. I think that may have run too much by the time it may sort of just be almost parabolic sort of growth. So I just think I'm not ruling it out completely, but that's where if you're in the next couple of weeks, you probably could. The other real dark horse is Dark Horse Darwin. Now we're going to have a session in a couple of weeks on this. So it's going to be interesting to see what it was sort of a bit of groundswell. I'm not convinced. I need to dive more into the data on that side of things. And data is not everything, but Darwin could be a potential option. I've just been doing some preliminary investigations, and it's not as cheap as I'd hoped. Yes, the median house price of Darwin is just over that $500,000. But there are some areas that are far more expensive than that. And I don't see a lot of kind of that 500K property value, which kind of makes me think, well, maybe it's not as right for the picking as what I thought it may have been. But maybe we'll have to see.
So no more in 2024. That's the tagline. No more properties in 2024. What do you mean
Maybe,
probably not? No, we've only got a month and a half left. We're not going to buy another one.
if we bought
But
one tomorrow,
2025, definitely, we've got some acquisitions. We've still got, as you can see, we have spent $407,000 of capital. We've got $500,000 of capital, so we've still got money to spend. We can afford to purchase this next property. Let's go jump through any kind of questions, because this has been I don't know, I've found this as a fun session. Anyone else, let us know. What questions have you got about anything about this portfolio? And share away, and we can bring them up. There was a question I want to see.
Is Joe doing Movember at the moment? He's got. I can't grow Mo. That'll be maybe a challenge for 2025. I love that Brian said, "Stop talking sense, Jeff Miles." Jeez, I mean, I don't know. I don't think maybe I did talk a little bit of sense. Would you build?
Maybe you
I
do,
love
mate.
this question.
Maybe you do. So would you build capital growth properties first and then focus on later acquisitions more on cash flow to help continue servicing and cash flow? How would you answer this one, Jeff?
So it entirely depends on your own kind of conversations with your broker and where you kind of where you're buying in as well, like what structure you're buying in as well. Individual name, once we're getting to the lending that we've got, I think you're going to be struggling for most people. Maybe Charlie Baylor's the world might not struggle, but no, most people are going to struggle. So to me, I want to focus is building the base, as I spoke about at the start of the session. So if you want that 150K, if you want to do it in 10 years or under, it's going to be very hard to do it via cash flow. So yes, to answer the question, that's the objective, and it's very deliberate. It's calculated. We are focusing on cash flow with value add. That if we don't get that capital growth, we can pull a couple of levers to extract that frozen equity from that property if we need to. What are your thoughts, Joe?
Yeah, spot on. It's exactly the right thing. The thing is, if you focus only on capital growth, cash flow first, you're not going to be able to continue growing, because look at that Perth market that we were looking at. It was growing 70% in 3 years. That's 2% every single month. Every single month, that property that's valued at $500,000 is growing monthly at $10,000 every single month. Can you save $10,000 a month? No, you can't. So you need the equity to be able to, and the capital growth to be able to go again, because just saving for cash flow is the focus. Also, I think, so I was having a prime example of this is, I had two investors that I was chatting with. One that had a PPOR, that had a lot of capital, that had a lot of money and equity backed up. And then I spoke to a brand new investor that didn't have a home, didn't have anything. And the investor with the home had this exact question. And there was a property that was high growth, and then there was a property that was high cash flow. And like what Jeff mentioned at the outset, you were saying, like, you want to pair these investments together where you can get good growth on one. So you create two portfolios side by side, two properties side by side, one that has high growth and one that's more cash flow focused. And then together they kind of net out as a nice little neutral standpoint. So that's an idea. But for him, it didn't matter if he got the cash flow one or the equity one first, because he had so much capital saved up, and he could make quick successive purchases. So really it was like, cool, the cash flow one comes, let's get it. The capital one comes first, great, let's just get that. It doesn't really matter, because you've got enough capital to go. Take it back to the investor person that's just starting out and only has $100,000 or $80,000 saved up. It's crucial that he focuses on the capital growth one, because he's not going to be able to go again. So if he just goes for cash flow, it's not really going to allow him as much. So if you can go again quickly after, then it doesn't matter as much. Does that kind of make?
Yeah, it definitely makes sense. Looking forward to see your transition from accumulation to income. I am as well. Just quietly. I think most people no, to your point about, yes, you can, there's the cash flow and capital growth. Some people are in a very fortunate position that's not as important. You need to have those conversations nice and early with your broker. Like, we're having conversations with our broker as to say, yes, we're extracting equity. What's the next one need to look like? What do we need to do? Well, it's probably buying the USA. No, we'll not be buying, or I won't. Yeah, I'm going to. I think, it's just there's not enough return, I feel, in overseas markets. Yes, there's huge potential, but I just don't understand.
There's just too much. There's too much potential in Australia. This is a great question.
Some
question here.
businesses make a profit, some
It's
make
more
a
of a
loss.
comment, more of a statement. Like a large business group, some business units make a profit and some make a loss, but they're there to support each other. It's like when you have a business that's like does sales and operations. Yeah, sales is amazing. Congratulations for making sales. But if the operation falls over, it's useless. So you've got to kind of have a bit of a balance in your portfolio. Another great question someone posted in there. I love the Melbourne property that you guys got with the value add renovations that you did. But also the cool thing is you've got the granny flat to help with that cash flow. So when we're talking about that transition phase that last person brought up, that's exactly what we can do. The property's made us equity in the short term. We've forced value in the short to medium term, and then we've cash flowed it at the end because we put a granny flat on it, or maybe knock down the garage and put an entire house at the back, made an extra couple of $100,000 and cash flow positive.
So I want to bring up this one, and it's a more specific question. What's your views on North Melbourne suburbs like Craigieburn for capital growth? Do you want to answer? I can take that one first, Joe. What are your thoughts?
You go.
So I'm going to answer it by I'm going to answer it by not kind of answering it. My focus has not been on Craigieburn. I'm not saying there's not value up that way. I kind of am seeing. I shouldn't be saying this on a podcast or a live session. I kind of think if I'm looking at Melbourne, we've got one in a pocket of Melbourne. I think there may be the eastern sort of side of Melbourne, and maybe it might be something that rhymes with Crankston. I'm not saying don't buy in Crankston, but no, that's potentially there's some arbitrage, maybe some opportunities down that way. I'd have to dig a bit deeper into Craigieburn for Craigieburn Way. I'm not saying I know some people definitely buying up that way. I've spoken to some friends; they are definitely loading in. I just haven't investigated enough, so I don't necessarily have a formulated view on that area yet. What are your thoughts? Do you have one, Joe?
Well, I mean, we did the live session last week with the H-tag guys, right? Where we distilled how to find the balance of supply and demand. Craigieburn is one of those areas that is a bit of a balance. There's a bit of a misbalance between that. The affordability index is pretty interesting. So the data side of things is looking quite juicy. So if I was somebody as an investor, I would be assessing all markets and trying to identify where it is. Jeff, is that link? It might be worthwhile sending that link to people that we did on the last live for the data. Because that person that just asked that question, you can kind of quickly at a glance get a bit of a context to the Craigieburn area to see what's going on, because it's quite interesting, right? We've got capital growth over the last year is 11%. Sorry, that's rents as 3.9%, so nothing crazy. Last 5 years, 35%. Renters to owner occupiers only 28%. Affordability, it's quite affordable. It hasn't gone as a crazy threshold. From a supply side of things, very, very limited. But from a demand side of things, 35 days on market, vacancy rates sub 2%, only just though, flatline trending down. So just a little bit of context to add to that. The other thing is you just can't look at the data though. Like look at the area itself as well, dig a little bit deeper, and there may be some red flags in some of these areas as well. Data only gets you so far. You do have to be able to. There's a little bit more to it. Did you have that link, Jeff? There it is. There.
I put it in the comments. I put it in the YouTube comments. I'll drop it in the Facebook as well. Actually, no, I've just copied somebody else's comment. Nice. So Moon's asked a really interesting question. I don't know, it's too hard to pick one, but I've kind of alluded to one that I would be looking a bit deeper in myself personally, just for my own. But so she said, if you pick one suburb in Melbourne, which one would you pick and why? I mean, to me, I'm suburb agnostic. I don't necessarily just throw suburbs out left, right, and center. Although I did mention one. I like the look of the Geelong region. I like the look of East Melbourne. Craigieburn. You could look up that way. You're not going to pin me to one suburb in Melbourne that I would be buying in, because I would be looking across multiple areas and then picking the eyes out of the deal. Because to me, if I can buy a cracking deal and the data looks half decent, I'm not gonna limit myself to one sort of suburb. Is that, I know it feels like a bit of a non-answer, but what are your thoughts on that, Joe?
Yeah, that was a non-answer. They want a real answer.
Well, you get which suburb are you buying?
Yeah, I just shared the link in the comments. I just posted the link in the comments. I think there's still a 20% discount on there. Maybe it's not. I don't know. It's worthwhile checking out. But you guys can get access to that. What was I going to say? Yeah, you got to do the research. Like, in terms of what area I'm buying, I spend too much time, energy, and effort to tell people where the specific locations that I'm buying. I'm sorry. I'm not going to do that, and I do not want the competition. So where I'm buying, yeah, let's have a chat. In terms of places I will send people, go to and you guys hang out over in Darwin or Tasmania, and leave me to my Victorian suburbs so I can soak it up before it becomes a difficult nightmare to buy. Right now, I'm enjoying the purchases in Victoria. There's good money to be made there if you do it right. Mate, this has been an unreal session. Thank you very much for the effort that you put in to create those slides and things. This is an interesting topic. I'm super excited we did this property portfolio. It's such a good marketing thing. I bet you're going to see more people talking about building property portfolios now. So guaranteed.
Maybe there are. Maybe there is. I just wanted to get out there, Joe. If you've enjoyed today's session, make sure you send this to people, team, because if somebody wants to build their own passive income, 150K, whatever income it is, if you've enjoyed this, send it along, because we want to spread the word. We want to make sure that people are getting this kind of information and getting on their way to financial freedom. Now, if you haven't left that review for us, we love the 5 stars, but get on that, and whatever platform you subscribe to, and jump on and follow along as well. And let us know. But Joe, as we always say to people, where you can reach me, Oz Property Investors. I'll be on there most not all hours a day, some. But Joe, if we want more of Joe in our lives, where can we get access to you? Can we get access to Joe?
Mate, if you want more, Joe, you want to know where we're buying and what we're buying, we have a Property Principles as a buyer's agency. So that's what I do day in and day out. I do this stuff all day. I look at nothing but data all day, and then we buy incredible deals. We are not a large scale, full, crazy, ridiculous 1,000 leads in and 1,000 shitty properties out. We only buy select properties. We work with a few clients at a time, and that's how we get the best results. It's very difficult to scale a buyer's agency without dropping quality of the output. But yeah, we've averaged 27% in the first 12 months for clients. So that's pretty good. Anyway, that's how you do it. Unreal session, mate. I appreciate you. Thanks, guys and girls that jumped in the comments. That was super fun, super good. And let's keep going. Let's go buy a property, guys. 2024. See you later. 2025. More deals to the portfolio. Thanks, Jeff.
We'll be back next week. But I was going to say, if people haven't seen it, go and check out our YouTube, because you've kind of gotten the very kind of high level. If you want to know more details, go and check out the session we did in September.
The start of the portfolio.
More detail. But as Joe says, let's go and buy a property in 2025 or 2025. Let's go buy, bro.
See you later. Have fun. Bye.